are three ways to minimize required minimum distributions. And here to talk with me about this is Robert Klein from the Retirement Income Center. Robert, welcome.
Thank you, Bob.
So before we talk about the ways to reduce RMDs, there are at least two things people need to know when they think about optimizing after-tax retirement income. What are those things?
Yeah, there's two components to that. One is maximizing retirement income, and the other one is minimizing income tax liability. Pretty basic, but that's what you need to do in order to maximize your after-tax retirement income.
Right. So you've described RMDs as a ticking time bomb. Tell us more about that.
Yeah, basically, every time you make a contribution, a deductible contribution to a qualified retirement plan, you're setting yourself up, in generally speaking, for taxable required minimum distributions down the line. So every time you make a contribution, you're adding to that layer of required minimum distributions that you have to start taking at 72. So it's something you need to think about when making a decision as to whether you contribute to a deductible 401k plan, for instance, or a traditional 401k plan, that is, or a Roth 401k plan.
Yeah. So short of not making these contributions to a qualified retirement plan, there are three ways to minimize RMDs?
Yep. The first way, and from a lot of standpoints, the preferable way, is to contribute to a Roth 401k and down the line roll it to a Roth IRA plan. By contributing to the Roth 401k, the obvious downside is you're not getting the tax deduction for your contribution, and that can be important in a lot of cases if you're in a higher tax bracket. Having said that, we are in a situation, and have been for a while, where we have historically low tax rates. So the tax contribution isn't as important as what's going to happen on the back end with taxation of your distributions. And the second part of this is rolling it into a Roth IRA, because if you maintain it in a 401k environment, whether it's a traditional 401k or Roth 401k, you are going to be subject to required minimum distributions. They won't be taxable, but you will have to take out specified amounts beginning at age 72, unless you're still working for your employer.
Right. And of course, one of the benefits of the Roth IRA is there are no required minimum distributions. So rolling it over would seem like an ideal way to reduce RMDs. Not everyone, Bob, has a Roth 401k at work. What's your thought about if that feature is not available?
If that feature is not available, then you should definitely be looking at a traditional 401k or a traditional IRA, or a Roth IRA, to the extent that you meet the requirements for that. If there's an income requirement, if your income exceeds a certain level, then you may not be able to contribute to a Roth IRA. But you should certainly look at traditional IRA, either deductible contributions or non-deductible contributions. You won't get as big a bang for your buck. The contribution limits are a lot higher with the 401k. Currently, you can contribute $20,500 a year, plus an additional $6,500 if you're 50 or over.
Right. So some folks have the ability to convert their traditional 401k to a Roth 401k?
Yeah. So if you either didn't have a Roth 401k up until now, let's say you just had a traditional 401k and suddenly your employer offers the Roth 401k, or if you just simply didn't contribute to the Roth 401k, second potential suggestion for minimizing your RMDs down the road is to do a conversion of your traditional 401k to a Roth 401k. And generally speaking, you want to do that in stages, in small bites, if you will, You don't want to do it all at once because that could cause a lot of tax liability. And also you need to consider the fact that if you do the conversion, the tax liability needs to be paid with after-tax money, non-retirement funds in order to make that work. So, a question comes up with the conversions of traditional 401ks to Roth 401ks as to, why would I want to go ahead and prepay income tax now? It's not required. And it's for the ability to, have your after-tax income during retirement maximized, because the reality is you're going to be making contributions for a limited number of years and for limited amounts, as limited by tax law. And once you're retired, you could potentially be retired for many more years. Number one. Number two, you will have earnings on all of your contributions. So you could potentially be taking out pretty sizable distributions down the road. So, it's once again doing some planning ahead of time and seeing, what is your situation projected to be. And that'll be the deciding factor as to whether it's worthwhile for you to pay taxes now to do the conversion. And by the way, the difficult thing is knowing, okay, what's my tax bracket going to be when I retire, especially because tax laws have a way of changing periodically. And given the fact that, we're in this low tax rate environment, even though you think you might be in a low tax bracket, you might have less income in retirement. I've seen situation after situation where that simply is not the case, especially if tax rates increase.
So one thing to note about these in-plan conversions is that not all plans allow them. So it's probably worth checking with your employee benefits department to see if it's allowed.
Yeah, that's a great point, Bob. Absolutely.
Yeah.
And, that's another thing, you should be doing up front as part of the investigative process when you're deciding, do I contribute to a traditional 401k or to the Roth 401k? To the extent that the conversions are not allowed, that might be a deciding factor to simply go with more of a Roth 401k situation. And by the way, it doesn't have to be an all or nothing decision. You can, contribute 50% to your traditional, 50% to your Roth, whatever works for you.
So there's a third way to reduce RMDs?
Yeah, it goes back to what you were talking about before, that not everybody has 401k plans. So the third way is if you have a traditional IRA that you've been contributing to, you can do Roth IRA conversions to that. And once again, unless you have a very small amount in your traditional IRA, I like what I call the staged Roth IRA conversion approach, where you do it in chunks over several years. But like the 401k conversion, you need to have non-retirement funds to pay the income tax liability. But basically, you're doing it for the exact same reasons as you would do a traditional 401k conversion, and that is to optimize your after-tax retirement income. That's the reason for paying the taxes now.
Well, Robert, we've covered a lot of ground. Anything we missed or anything that bears repeating before we wrap up?
Just, two things I want to emphasize, once again, this low tax rate environment that we're in, that is going to definitely go away after 2025. We're going to revert to previous tax laws, and it could happen sooner. And number two, just to, keep in the back of your mind the end game when you're deciding, okay, where do I contribute? Is it a Roth or is it a traditional 401k, Roth IRA, traditional IRA? And, think about that in terms of potential required minimum distributions. To the extent yeah, you're going to have required minimum distributions besides potential additional regular tax liability that can result in other spillover taxes, as I refer to them, such as higher Medicare Part B premiums, to the extent that you don't use up your plans during your lifetime and your spouse or your kids inherit it, they may pay higher taxes potentially. It just totally, it complicates your whole retirement situation when you have required minimum distributions to deal with, especially when you don't know what the tax law is going to be when you retire and throughout your retirement.
So before I let you go, I want our viewers to know that you and we speak monthly about the articles that you write for Retirement Daily, but you've also launched a new YouTube channel where you're producing videos as well under Financially Inclined. Tell us a little bit more about that before we wrap up.
Yeah. Thank you for mentioning that, Bob. Basically, it's just another way to communicate, with my clients and educate them, clients and potential clients about, the strategies that you and I discuss, all with a retirement income planning emphasis. That's what it's all about. And to the extent that I do these videos, it's another way for me to just stay on top of what's going on in the retirement income planning area.
Well, Robert, thanks as always for being with us, sharing your knowledge and wisdom with our viewers. And your articles. It's greatly appreciated.
Thank you, Bob.